When it comes to figuring out how much of your salary should go towards your bond, there is a lot to take into account. While there is not one specific universal formula, the ultimate decision will be based on your own calculations specific to your individual needs. By simply watching this video, I want to commend you on making one of the most important financial decisions you'll ever make with precise thought and detailed research. By the end of this video, you will know how the bank calculates what they're willing to offer you as far as the bond amount is concerned, as well as how to prepare for this number so that by the time the bank gives it to you, you're already on top of your game. I will show you how to take your own personal circumstances into account so that you know how much you can work with every month to a number that is specific for you as an individual. I'm Sibilolo Makwanyane, aka Sibilolo the Estate Agent, and welcome to the channel where we help first-time home buyers and first-time home owners make wise decisions when it comes to their property investment. Go ahead and subscribe to the channel and like the video if it makes sense to you, and click the notification bell so you can be updated every time a new video is loaded. A lot of people assume that your bond repayments are calculated purely on your salary, meaning that the more you earn, the bigger of a house you can afford. And while this is not necessarily incorrect, when the lender calculates how much of your salary should go towards your bond, they take into account money that belongs to other people in the form of debt that you are committed to. So say we've got two people that both earn 38,000 Rand. One has got a paid up car and the other one has got vehicle installments of, let's say, 5,000 Rand. The one with the paid up car will get access to more credits, meaning a bigger, nicer house, because they've got less financial commitment. So when the bank calculates how much of your salary they're going to allocate towards your bond, they use a formula called debt to income ratio, which, as the name suggests, is the ratio between your income and your debt. It's basically to ensure that once your bond has been registered, you will be able to make the minimum repayments and not find yourself in a position where you cannot afford your house. So the National Credit Act is very strict when it comes to irresponsible lending, and they really put a lot of pressure on the lenders to not overwhelm the consumer with debt, and that of course includes your bond repayments. When it comes to calculating your debt to income ratio, you simply take your monthly commitment to debts and divide it by your gross monthly income. Then you times it by 100 so that you get a percentage number. So say you earn 45,000 Rand. That is before taxes, before your pension and things like that. And you've got financial commitments of a personal loan, maybe a credit card, a car or something like that. But it adds up to a total of 8,500 Rand every month. So we're going to take this 8,500 and divide it by 45,000 Rand, which gives us an amount of 0.18. And you times it by 100, so we've got a percentage number, which then takes us to 18%. That is the debt to income ratio. I know that not everybody will like the idea of sitting down and calculating. So what I'll do is I'll add a couple of online calculators that will allow you to simply punch in the numbers and it will automatically pop out with your debt to income ratio response. Despite the bank using this basic formula, it is very important for you to sit down and draw up your own budget for you and your household in order to know how much you can afford despite what the bank comes back with. If you've got a child who is particularly talented, so let's say, for example, they are a provincial athlete, you'll know that they are always on a tour. So now you need to sort them out from moving from Potchefstroom to Hermanus, from Mhlanga to East London. Anyone who is the parent of a high achiever in any field will know how expensive it is to nurture your child's talent and continue to give them the financial support that they need in order to thrive. Your expenses will be substantially higher from somebody who's got I want to say an average child. I don't mean to be disrespectful. I honestly just can't think of a better word to use. I'm simply trying to say that even though it might look like, oh, okay, this person's only got one child, so a child costs about this much, this could be very different in reality because of their own specific circumstances and their own financial commitments. Even though some of your expenses might not necessarily appear on the credit bureau, if your child's violin gets damaged or lost or stolen, it's not good enough for you to just say, sorry, Nana, we can no longer support you because we've now bought a house. So these are the type of things that you need to take into account when you consider how much you can actually spend on your house every month. So now looking at your debt to income ratio, ideally you want to keep this number as low as possible. I need you to remember that the bank looks at your monthly commitment when they calculate this and not your outstanding amount. So say, for example, you've got two people that both have a personal loan and their repayment is 2,900 Rand. Even though one may be 7 months from paying off their loan and the other person still has a commitment of 4.5 years, despite what their total outstanding balance is, the bank is only going to consider this commitment on a monthly basis of 2,900 Rand. Let's now look at this debt percentage in relation to your income. Now, what the bank will most commonly do is take 30% of your gross income. So if your salary is 45,000 Rand, 30% is then 13,500 Rand. Hold on to that. We're going to come back to it in just a second. The second thing they'll do is take your net income and remove all of your expenses. If you are at the time currently paying rent, this will not be calculated as part of your expenses because you will no longer be paying rent once you've purchased your property. Say your net or your income after all of your deductions is 31,000 and your current financial commitment, your expenses are, let's say, 15,000 Rand. Then that is going to give you a surplus of 16,000 Rand. That's the amount that you've got left after all of the deductions have been taken off from your net salary. Then the bank is going to go back and take 30% of your gross, which we agreed was 13,500 Rand, and compare it with the surplus from your net, which we agreed was 16,000 Rand. Now, between these two amounts, the one that they're going to choose as a form of calculation is the one that is the lowest. So in this case, it's a 30% of the gross, meaning they choose the 13,500 Rand over the 16,000. But because we are talking about monthly repayments, and the bank will give you an affordability amount as one big lump sum, we then need to convert this monthly amount into a once-off lump sum, which is called the bond amount that the bank is going to offer you. The first thing the bank considers is interest rate. If you can afford 13,500 Rand every month, the total bond amount that you will qualify for will depend on what the current interest rate is. So say, for example, prime is 11.5 at the time, then you will be able to buy a house of 1,260,000. Now, if prime decreases to 10.25%, you will then qualify for a bond of 1,380,000. Because in both cases, your bond repayment will be 3,500 Rand. So how do you go about calculating what is the lump sum that you will qualify for? Okay, so this is a little bit more tricky. It's kind of like a trial and error type of thing. It's the only way that I know how to calculate it. So if you can figure out another way, please do share.
So we are going to look for a bond calculator. I just happen to use Uber. You can use whatever is convenient for you. So the most important thing is to make sure that you're using a bond repayment calculator and not an affordability calculator, because that's going to give you a different result. So first up, the purchase price is empty at the moment. We are agreeing on 20 years for the repayment. There is no deposit. And this interest rate part, so usually these bond calculators will automatically give you whatever prime is at that time. But in this case, we want to see what's going to happen if prime is 11.5%. So we adjust the interest rate. Then the purchase amount is going to affect the bond repayment. So we are trying to see how much we can get the monthly repayment, the purchase price, in relation to this interest rate with regards to the monthly repayment. So we're going to try it at 1,000. We're going to try it at 1,000,000 first. So basically, if we purchase a property of R1,000,000 at 11.75%, the repayments are going to be 10.6 thousand rand every month. So remember, we're trying to reach 13,500 because that's what the bank has said we're allowed. So now let's try 1,500, 1.5 million. Then that gives us bond repayments of 15.9. So now we've gone over. Let's try 1,300,000. Let's try that one. It gives us 13,800, slightly above. We can try 1,260. That gives us 13,400, which is a lot closer to the 13,500 rand. So now you know that if you want to purchase a property and you can afford 13,500 rand, if prime is 11.5%, you should be able to afford more or less 1,260,000. Then we're going to adjust the interest rate and do exactly the same thing. So we'll just adjust the interest rate. I think we said 10.25. Hope I'm correct. Then we're going to try it. Let's start it at 1,000,000 and see what happens. That's going to give us 9,000. So we've got a lot more space. So with this one, I have played around with it. I think it gives us 1,380. Yeah, there we go. So if the interest rate is 10.25%, then with the repayments of about 13,500 rand, you should be able to afford a house of about 1.38 million.
Despite what the interest rate is at the time, the lender always makes way for a little bit of leeway for changes in the interest rate. So should there be any small adjustments, you should still be able to afford your bond. Going back to the debt to income ratio, if that percentage is too high, it's going to decrease the total bond amount that you're going to qualify for. Despite this 30% average that is used by the bank, you need to check your personal numbers and play around with it so you can get a budget that is realistically for you, no matter what the bank comes back with. Also remember that even if your salary and your debt to income ratio and all the other numbers make sense, it doesn't mean you automatically qualify for a bond. The lender takes into very serious consideration your credit score as well as what is happening on your credit report. Go check out this video that will explain to you how your credit score affects your bond.